Markets don't fear bad news. They fear what most people haven't noticed yet. Most people think markets move because of headlines. A number flashes on the screen, a price jumps, a commentator explains it after the fact. But that's rarely where the real risk starts. Markets don't usually break when bad news arrives. They break when the structure underneath quietly changes, when the rules of participation shift, and most people don't realize it yet. Price is visible, structure is not. When something important changes in how a market is traded, who can stay in a position, how much capital is required, or how risk is redistributed, the impact often shows up before the headlines catch up. That's when volatility increases. That's when positioning changes. That's when outcomes start to diverge from expectations. Right now, many investors are focused on where silver is trading today, up or down, strong or weak. That focus misses a more important question. What changed recently that alters how this market functions? Not just what the price happens to be at this moment. This isn't about panic. It isn't about hidden enemies or dramatic predictions. It's about recognizing when a market transition is underway and understanding what that means before emotion takes over. In the next few minutes, let's step away from opinions and look calmly at what actually changed, when it changed, and why professionals pay attention to moments like this. Calm, neutral, verifiable. Over the past several weeks, the silver market has experienced a series of structural and pricing changes that occurred in a relatively short period of time. First, margin requirements for silver futures increased. In mid-January 2026, CME Clearing implemented a change in how margins are calculated for several precious metal contracts, including silver. Instead of relying primarily on fixed dollar margins were transitioned to a percentage-based system tied to the notional value of the contract. This adjustment became effective on January 13, 2026. Following that structural change, margin levels for silver futures were raised multiple times within weeks, reflecting higher volatility and price movement. Public reporting from market data providers shows that required capital to maintain a silver futures position increased materially compared to early January. At the same time, silver prices moved sharply higher. Silver futures traded above the $110 per ounce level during this period, marking a significant advance compared with prices seen earlier in the month. The speed of the move, rather than just the level, contributed to higher volatility readings and triggered risk recalculations by clearing members. In parallel, gold prices reached record highs, with spot gold trading above $5,100 per ounce in late January 2026, according to widely reported market data. Gold's move occurred alongside increased interest in precious metals broadly, including silver. On the physical side, delivery activity on the U.S. Futures Exchange increased compared with typical seasonal patterns. January, which is not considered a primary delivery month for silver, recorded higher than usual delivery notices relative to historical averages for non-primary months. Exchange delivery reports show continued withdrawals from registered inventories during this period. Internationally, China implemented new export licensing rules for refined silver effective January 1, 2026. Under this framework, a defined group of approved companies is authorized to export silver, altering the flow of refined metal into global markets. Taken together, these developments occurred within a compressed time frame. Margin methodology changed. Required capital to hold futures positions rose. Prices moved quickly. Physical delivery activity increased. Global trade rules adjusted. These are observable events. They do not imply intent, motive, or outcome, only that the operating environment for the silver market shifted materially in a short span of time. Analytical, mechanism-focused, non-emotional. To understand why these developments matter, it helps to separate price movement from market mechanics. A change in margin structure does not directly move prices. What it changes is who can remain positioned when volatility increases. When margin requirements rise, especially when they are tied to a percentage of contract value, the immediate first-order effect is an increase in required capital for existing positions. Traders who use leverage must either add cash, reduce position size, or exit entirely. This process happens regardless of whether their underlying view on the market has changed. The second-order effect appears in liquidity and positioning. As some participants reduce exposure, open interest can decline, bid-ask spreads may widen, and price swings can become sharper. Markets become more sensitive to flows rather than fundamentals, at least temporarily. This matters most for participants using futures for directional exposure, rather than for hedging. Commercial users hedging production or inventory typically plan for margin variability as part of their operating costs. Smaller speculative participants, by contrast, are more exposed to sudden capital requirement changes. At the same time, increased physical delivery activity introduces another layer. Futures markets are designed primarily for price discovery and risk transfer, not for large-scale physical settlement. When delivery demand rises outside of typical seasonal patterns, it can signal that some participants prefer physical exposure over paper exposure under current conditions. That does not imply shortage by itself, but it does suggest a shift in preference from financial exposure to tangible inventory, which can influence how futures prices relate to physical markets over time. The introduction of export licensing rules in China adds a further dimension. When a major refining and processing hub alters how material can leave the country, global supply chains must adjust. In the short term, this can change trade flows, inventory locations, and delivery timing. In the longer term, it may affect how regional premiums develop relative to futures prices. The combined effect is not a single dramatic outcome, but a change in market sensitivity. Futures prices become more responsive to positioning and liquidity. Physical premiums become more reflective of regional supply conditions. Volatility increases as different segments of the market respond to different incentives. For investors and traders, the key implication is this. The risk profile of silver is no longer driven solely by price direction. It is increasingly shaped by how exposure is held, where metal is sourced, and which participants are able to stay active as conditions evolve. Understanding these cause and effect relationships matters more than reacting to daily price moves, because structural shifts tend to influence markets before they become obvious in headlines. Perspective, debiasing structural comparison. Periods of heightened volatility and structural change in the silver market are not unprecedented. However, history is most useful when it is used to filter emotion, not to predict outcomes. One commonly referenced period is the late 1970s, when silver prices rose rapidly alongside inflation, currency instability, and rising investor demand for hard assets. In that environment, leverage increased, positioning became concentrated, and exchanges responded by adjusting margin requirements. Price volatility followed. What is often overlooked is what happened before the outcome, not after it. In prior episodes, stress tended to build gradually. Volatility increased first. Participation narrowed as capital requirements rose. Liquidity became less evenly distributed. Price swings grew larger as fewer participants set marginal prices. These conditions existed before prices peaked or collapsed. They were structural signals, not timing tools. However, today's market is not a repeat of the past. Several key differences matter. First, the composition of demand has changed. Silver now plays a much larger role in industrial applications, particularly in electronics, renewable energy, and advanced manufacturing. This introduces a layer of demand that is less sensitive to short-term price fluctuations than speculative investment demand. Second, the financial system is more interconnected, and risk controls are more formalized. Margin adjustments today are often automated and model-driven, rather than discretionary responses to specific participants. That changes the pace and transmission of stress, even if the effect on leveraged traders feels similar. Third, global supply chains are more complex. Changes in export rules, refining capacity, or regional inventory flows can affect pricing relationships across markets without implying an absolute shortage. These dynamics were far less pronounced in earlier decades. Finally, market transparency is higher. Data on inventories, deliveries, and positioning is more widely available, which can accelerate reactions, but also allows for earlier detection of stress signals. The historical takeaway is not that silver must rise or fall in a particular way. It is that markets undergoing structural adjustment often experience outsized moves, both upward and downward, as participants adapt to new constraints. History suggests caution against emotional extremes, both optimism and fear. It reminds us that structural change creates uncertainty, and uncertainty rewards preparation more than prediction. Risk-aware, conditional, non-deterministic. Rather than assuming a single outcome, professionals typically evaluate markets through scenarios, each defined by specific conditions. This approach helps manage risk without relying on certainty. Below are three broad scenarios for silver based on current structural conditions. None are predictions. Each depends on what happens next. Bull case, structural tightness persists. If physical demand remains firm, and if delivery activity continues to exceed historical norms relative to seasonal patterns, and if volatility remains elevated without a collapse in liquidity, then silver prices could continue to find support at higher levels. In this scenario, margin-driven deleveraging would largely be absorbed by participants with longer time horizons or lower leverage. Futures prices would gradually adjust to reflect tighter positioning and sustained interest in physical exposure. Additional confirmation would come from stable or rising open interest despite higher margins, continued withdrawals from exchange inventories, physical premiums that persist without accelerating sharply. This outcome would suggest an orderly repricing rather than a speculative blow-off. Importantly, it would require discipline on the upside, meaning gains driven by structure and demand, not momentum alone. Base case, volatility, normalizes, structure stabilizes. If volatility declines from recent extremes, and if margin requirements remain stable without further sharp increases, and if physical delivery activity returns closer to historical averages, then the most likely outcome is range-bound consolidation. In this environment, silver prices may fluctuate within a wide band as markets digest recent changes. Positioning would normalize, and liquidity would improve as participants adapt to the new margin framework. This scenario assumes no major supply disruptions, no sharp reversal in precious metal sentiment, gradual adjustment by both hedgers and investors. From a professional perspective, this is often the highest probability path following rapid structural shifts. Markets frequently pause after repricing risk, allowing fundamentals to reassert influence over time. Bear case, liquidity shock overrides fundamentals. If margin requirements rise further in response to renewed volatility, or if leveraged participants are forced to exit positions simultaneously, or if broader financial conditions tighten sharply, then silver could experience a rapid downside move driven by liquidity rather than fundamentals. In this scenario, price declines would reflect forced selling, not a sudden change in physical demand or long-term supply dynamics. Such moves tend to be sharp and emotionally charged, but often short-lived once selling pressure exhausts itself. Warning signs would include falling open interest combined with rising volatility, abrupt declines during periods of thin liquidity, correlated selling across risk assets. This outcome would reinforce a core market principle. Structure can dominate fundamentals in the short term, especially when leverage is involved. Scenario summary. The key point is not which scenario unfolds, but what conditions would signal a transition from one to another. Markets rarely move in straight lines. They rotate between regimes based on liquidity, positioning, and confidence. A disciplined approach focuses less on forecasting prices and more on recognizing which environment is currently forming and adjusting risk exposure accordingly. Rather than focusing on headlines or short-term price targets, I pay attention to a small set of indicators that help distinguish structural change from temporary noise. First, the US dollar index, DXY. Silver and the dollar often move inversely, but the relationship is not mechanical. What matters more is how silver behaves when the dollar strengthens or weakens. If silver holds firm or advances during periods of dollar stability or modest strength, that suggests underlying demand resilience rather than purely currency-driven moves. Second, U.S. Treasury yields, particularly real yields. Rising real yields tend to pressure non-yielding assets like precious metals. If silver remains supported despite stable or rising real yields, it implies demand beyond macro hedging, often linked to industrial or physical considerations. Third, inflation data, CPI and PCE. Not because inflation numbers move silver instantly, but because they shape expectations around monetary policy. Shifts in policy expectations influence liquidity, leverage, and risk appetite, all of which feed into futures positioning. Fourth, volume and liquidity conditions. I look closely at whether price moves are accompanied by rising or falling volume. Large moves on declining volume often signal exhaustion rather than conviction. Liquidity conditions tell us whether markets are absorbing stress or amplifying it. Fifth, open interest and positioning. Changes in open interest help clarify whether a move is driven by new participation or by liquidation. Rising prices with falling open interest often indicate short covering. Rising prices with stable or increasing open interest suggest new exposure entering the market. Finally, exchange inventories and delivery trends. Not as timing tools, but as context. Persistent inventory declines or elevated delivery activity can indicate shifts in preference toward physical exposure, even if prices temporarily move against that trend. None of these indicators provides answers on its own. Together, they form a framework for understanding how the market is evolving, not just where prices happen to be today. Periods like this tend to feel uncomfortable, especially for markets that attract strong opinions. Rapid price moves, changing margin requirements, and shifting participation can create the impression that something unusual is happening, and structurally, that may be true. But uncertainty does not require urgency. Markets regularly transition through phases where rules, incentives, and behavior adjust. The role of analysis is not to predict dramatic outcomes, but to recognize when conditions are changing and respond with discipline. For investors and traders, that means respecting risk, understanding how exposure is held, and avoiding decisions driven by short-term emotion. Leverage amplifies both opportunity and error. Structure matters as much as direction. This isn't investment advice. It's simply how I'm reading the market right now. Patience, position sizing, and a clear process matter more than being early or being loud. Over time, markets reward those who stay grounded when conditions are unsettled.